In the last episode, we worked through time value of money problems involving a single lump sum, either received today and compounded forward to a future value, or received in the future and discounted back to a present value. And while those situations do arise, most real-world applications involve a series of cash flows over time. Think about loan payments, lease payments, or bond coupon receipts. These are all streams of cash flows, and in accounting and finance, we regularly apply time value of money concepts to analyze them. Now, broadly speaking, when working with a series of cash flows, we can place problems into one of two categories. Either the cash flows have identical amounts and identical timing each period, or the amount, the timing, or both vary. So when both the payment amount and the time interval are constant, these are even cash flows. For example, receiving 5 payments of exactly $5,000 at the end of each year over the next 5 years would be an even series of cash flows. If instead any payment amount differs, or if the spacing between payments changes, the series becomes uneven. So a couple of examples in practice, a standard fixed-rate mortgage produces even cash flows, while analyzing a business acquisition typically involves uneven cash flows. Now, I don't want to make it sound as though these are two wildly different situations. The underlying concepts are the same for both types of problems. I'm separating them for two reasons. First, even cash flows are commonly tested on the CPA exam. And second, when payment amounts and timing are constant, we can use mathematical shortcuts that simplify the calculations. So for the rest of this episode, we'll focus on even series of cash flows, and then in a couple episodes we'll turn to uneven cash flows. So to begin, a series of equal payments made at equal time intervals is called an annuity. And annuities come in two forms: an ordinary annuity, where payments occur at the end of each period, and an annuity due, where payments occur at the beginning of each period. In annuity problems, we refer to each cash flow simply as a payment, whether the cash flow is received or paid. So a timeline of an ordinary annuity with payments of $2,000 would look like this, where lowercase t represents the time period. And to compute the future value at the end of the third period using a 5% interest rate, we treat each payment as a single lump sum and apply the same compounding technique from the previous episode. The first $2,000 payment made at t equals 1 compounds for 2 periods, giving $2,000 multiplied by 1.05 squared, or $2,205. The payment at t equals 2 compounds for 1 period, resulting in $2,000 multiplied by 1.05, or $2,100. The payment made at t equals 3 is made right on the future value date, so it doesn't compound at all. Adding these together gives a future value of $6,305. And the same logic applies when calculating present value, except instead of compounding payments forward to a common future date, we discount them back to a common present date. So if we repeat the process for an annuity due, where payments are made at the beginning of each period, the timeline shifts accordingly. The payment made at t equals 0 must be compounded for 3 periods, which we can calculate as $2,000 multiplied by 1.05 to the third. And that equals $2,315.25. The payment made at t equals 1 compounds for 2 periods, resulting in $2,205. And the payment made at t equals 2 compounds for 1 period, giving $2,100. Summing these values produces a future value of $6,620.25 for the annuity due. And the manual approach works fine for 3 payments. And with a spreadsheet like we see here in Excel, we could easily extend this to many more periods. But when dealing with an even series of cash flows, we can also use time value of money calculators and built-in time value of money functions in Excel. For example, you can see here we've gone through the manual calculations for the ordinary annuity we just looked at. We have our 3 periods and have calculated each lump sum manually and summed them up. But we can also automate this with Excel's built-in future value function. So we'll say equals FV, and then the inputs are straightforward. The interest rate per period, which is 5% in our case, the number of periods, which is 3, the payment amount of $2,000, the present value, which is 0 since we're not starting with an initial balance, and finally the last input is a 0 to indicate that these payments occur at the end of each period, which is what we want because we're calculating this for an ordinary annuity. And as you can see, entering these inputs gives us the same $6,305 future value we calculated manually. Now you'll notice it does present it as a negative value by convention, which makes sense if we think about it. By inputting our payment as a positive value in the formula, we're telling Excel that we receive payments of $2,000. What Excel is then telling us is that 3 periods in the future, at a 5% interest rate per period, we would have to pay the entity that we're receiving the $2,000 payments from a total of $6,305 to pay back the principal and interest. It presents the cash outflow from our perspective as a negative value. If we flip our payments to a negative $2,000, this will signify to Excel that from our perspective these are cash outflows, and at the end of the 3 years we would expect to receive $6,305 back as a cash inflow to be repaid the principal plus interest. Now we can also use this formula to calculate an annuity due. You can see here we have the same manual calculation we walked through for that example. And if we again say equals FV, our interest rate is 5%, number of periods is 3, our payment is again $2,000, the present value is 0, but this time the last input is 1 to indicate an annuity due. And the result again matches our manual calculations. So both of these examples confirm that the calculator shortcut is simply automating the same compounding logic we walked through manually. And Excel also includes functions for every other time value of money variable. For example, we can use the rate function if we're given the number of periods, the payment amount, and either or both a present or future value. In our annuity due example, we would enter 3 periods, a payment of $2,000, a present value of 0, and a future value of $6,620.25 entered with the opposite sign of the payments to satisfy Excel's sign convention. We then specify 1 to indicate an annuity due and provide an initial guess such as 10% because Excel will solve this through an iterative calculation. And you can see the function returns an interest rate of 5%. In the same way, we can use the payment function to solve for the payment amount if the rate, number of periods, and target future value are known, which in our ordinary annuity example gives the expected $2,000 payment. Now, when working with time value of money problems, calculators like those built into Excel are very powerful, but they're not the only shortcut available. For annuities in particular, even series of cash flows, you may also encounter factor tables for calculating present and future values. You can see an example of a factor table on the screen for the future value of an annuity due. Interest rates appear across the top and the number of periods along the side. What we're looking for is a factor relevant to our calculations. So if we look at the table, for 3 payments at 5% interest, the factor at their intersection is 3.31013. And multiplying our $2,000 payment by this factor produces $6,620.26, which matches our earlier results that we calculated manually with Excel's future value function. It's 1 penny higher just due to rounding. Now, factor tables like this also exist for present values, ordinary annuities, and single lump sum problems. And if you sit for the CPA exam, you will almost certainly encounter them. However, they do have limitations. The table is only useful for the specific interest rates and periods listed, so it wouldn't help us if the rate were 4.5% or anything not shown as a column. It's also important to recognize that the values in the table are not arbitrary. They can be derived directly from the compounding logic we've already covered. For our annuity due example of 5% interest for 3 periods, the factor shown in the table was 3.31013. And recall that for an annuity due, payments occur at the beginning of each period, so the first payment compounds for 3 periods. That gives us 1.05 raised to the third, which equals 1.157625. The second payment compounds for 2 periods, producing 1.1025. And the final payment compounds for 1 period, giving 1.05. When we add these 3 compounding factors together, the total is 3.31013, exactly the factor shown in the table. And we can apply the same logic in reverse for present value. In a present value factor table for a single lump sum, the factor at 6% for 2 periods is 0.89. If we discount a cash flow for 2 periods at 6%, we divide by 1.06 squared. Since 1.06 squared equals 1.1236, taking 1 divided by 1.1236 gives us 0.89. So this highlights that factor tables, Excel formulas, and financial calculators are not doing anything mysterious. They're simply automating the compounding and discounting mechanics we've already worked through manually. Now, the last note before we wrap up. You'll also see closed form formulas in textbooks for the present and future value of annuities. For example, the present value of an ordinary annuity can be calculated by multiplying the payment by 1 minus 1 plus the periodic interest rate raised to the negative number of periods divided by the periodic interest rate. Conceptually, however, this formula is simply a shortcut for the same discounting logic we've already applied. And in practice, you're unlikely to write out these formulas manually. Instead, you'll rely on Excel or another time value of money calculator. And in this series, our focus remains on understanding the mechanics rather than memorizing equations like this closed form formula. So that covers the fundamentals of annuities. In the next episode, we'll add a bit of complexity by examining deferred annuities and situations where a single lump sum is combined with an annuity.